Thomas Castelli is a CPA, a podcast co-host for the Real Estate CPA, and a multifamily real estate syndicator. He completed his first syndication as a general partner of an 82-unit apartment community, and he has participated in many deals as a limited partner. In this episode, he shares with us the thought process of a limited partner when looking at investing in other people's deals. Welcome back to another episode. Today we have joining us Thomas Castelli from New York. Thomas, welcome to the show.
Dion, thanks for having me today.
Thanks for joining us. So why don't we tell our listeners a little bit about your background and what you're doing with regards to real estate right now?
Absolutely. So my background, I'm a CPA. So I started out, I went to college, and during my college years, I kind of realized, hey, look, I don't really want to work the 9-to-5 grind that everybody works when they come out of college. And I decided that I needed another way. So I picked up the Rich Dad Poor Dad books, as many people do, while I was still in college, read them, fell in love with real estate, started going to networking events, reading everything I could on the subject. And then ultimately, I went to a 3-day weekend where they were teaching apartment syndication, and I fell in love with syndication. So I went to that meeting shortly after I graduated college, and then I went to work for a national accounting firm where I was an auditor, gained some of my experience as an accountant, got my CPA license, and during that time, I started making some investments in limited partnership interests in multifamily properties with a mentor, someone who eventually became my mentor. And then from there, I ultimately found a property in Jacksonville, Florida, 82 units, brought it to my mentor, and we ended up doing a syndication with this small group of people. I was a general partner, and we recently just wrapped up that syndication in mid-May of 2020. So that was exciting. So that's my background. Started off as a CPA, started off investing, and then here I am today.
That 82 unit, you said basically you took that full cycle, right?
Yep. From that position to this position.
Yeah. So can you tell us a little bit about that? How did you find that one? That was your first deal.
Yeah, so it was a long journey to get to that first deal. It's a lot of cold calls, a lot of networking with brokers, a lot of just a ton of networking. And I probably made 200-300 cold calls before I finally met the broker who sent us this deal. And we had this number of deals that came through from this broker, and a lot of them we're looking for a value add play. And a lot of them were were stabilized deals. So they had largely went through the value add. And then we found this property. So long story short, made a lot of cold calls, got in touch with this broker, then found this deal.
Well, so with regards to, let's say the tax implications and everything about this deal, the 82 units, after you guys cashed out, did you roll it into like a 1031, or kind of what was the strategy or thought process behind that?
Yeah, so we just recently wrapped up the deal. There was no special tax treatment, no special strategies we did with this. We had investors. We had a crowdfunding was the core source of our equity. And we sold it during COVID. So the goal was to bring it to just a sale. A sale was the goal, and we made it there. Right now, the funds were only recently distributed, and right now I'm evaluating the options of what's next. That's something that I'm currently doing right now.
Mm-hmm. So as a CPA, and from this perspective, how do you go about evaluating your investments?
Yeah, so it's definitely from a CPA's perspective. I mean, even though I am a CPA, I always look at the deal first. I always look at it as an investor first. Deals always have to make sense from that investment perspective. The tax implications come second. Typically, when I'm investing as a limited partner, I'm looking for sponsors that are going to be doing cost segregation studies on their properties. They're going to be generating those losses in the initial year or years, so I can offset that with against the other passive income that I have from other real estate, perhaps like the sale. So, for example, this year we just sold this apartment community. We're going to have a capital gain from it. I'm going to be looking for either to make a direct investment in real estate or make an investment as a limited partner and run a cost segregation study on that property if I'm doing it myself, or if the sponsor will run a cost segregation study. That's going to generate a passive loss. And I'm going to be able to use that loss to offset the capital gain from the sale of this investment. So it's all about that cost segregation study.
So what about when it comes to just LP investors? Because I know that there's the real estate professional rule and everything.
Mhm.
In order for the what is it, the losses to basically apply, that they could apply it to their W-2 income, right? Maybe you
Yeah.
could clarify that a little bit more.
Yeah, it's definitely a source of confusion for a lot of investors, right? So the way it works is what happened was back in 1986, it was the Tax Reform Act of 1986, where the tax code made all rental activities passive, regardless of whether or not you participated in the activity. And that was a result of a lot of highly paid professionals like doctors and what have you. They would make tremendous amounts of money in their jobs, and then they'd go buy a rental property or rental properties and basically use the losses against their income. And the IRS didn't like that. So the IRS said all rental activities are now passive. And then from there, real estate investors started complaining, like, hey, look, I do this full time. Why can't I use my losses? So then they introduced the real estate professional status. And the real estate professional status, if you meet certain requirements, which is you work 750 hours, at least 750 hours in a real property trader business and more than 50% of your total working time, you can qualify as a real estate professional and have your losses offset your other income, perhaps your W-2 income. If you're not a real estate professional, then your losses are treated as passive. So what does that mean? That means for most limited partner investors, people who are passively investing in real estate, the losses that are generated, usually from the K1 of your investment, are going to be able to offset any other real estate investment income you have, for the most part. So that's capital gains from the sale of real estate, and that's rental income, net rental income, perhaps from properties that are cash flowing. But the excess of those losses are going to have to be carried forward. And when they're carried forward, they can be used in future years against real estate income, against other passive income, primarily from real estate for real estate investors. Otherwise, the short answer is that it does not offset your W-2 income if you're a passive investor for the most part.
Unless you can prove the real estate professional, and then it could offset it.
Yeah, if you're
Okay.
real, so yeah, if you're a real estate professional, what you can do as a real estate professional, if you have your own portfolio, like say I have my own portfolio and I can prove the real estate professional status, and then I go and invest with you, let's just say, and I'm a passive investor. If I meet certain requirements, I'm able to group in the investment I have with you with my own portfolio and use the losses from that LP investment against my other income, so long as I'm a real estate professional.
Mhm. Mhm. So with regards to proving the 750-hour minimum or 50%, of your time, what would you suggest for people to go about documenting this?
Yeah. So the one big saving grace in almost all IRS court cases has been a proactive time log, meaning you've been taking a time as you've been going along. So we recommend keeping a time log. Most of our clients are using at the Real Estate CPA. Most of our clients are using an Excel spreadsheet where we recommend that they document their hours either on a daily or weekly basis, just to keep themselves up to date rather than going back and trying to like backlog it. Other clients use apps like Toggle or T-Sheets to track their time. Those are like specifically time tracking apps. The ability to track your time and show that log, like I said, is critical. If you're full time in real estate, it's relatively easy to do because you only have to track your real estate time. But if you're part time, you have a part time W-2 job, or you have another business, it's crucial that you also track that time too. Because what's going to happen is under an audit, the IRS would come to you and they're going to try to say, okay, well, you worked more time in your other business or your other job than you did in the real estate job. So in that case, it's important to check both your hours. And the IRS will go to extents. They will pull records from your employer. They'll go and like subpoena your employer, ask them for certain records to prove that you're not a real estate professional. So keeping the time log is absolutely essential. And the last thing I'll say on that is a lot of people say, well, why do I have to do that? It's like a tedious task. Well, there's no free lunch. And the bottom line is the real estate professional status can have tremendous tax benefits for you. I mean, I've seen people wipe out their entire tax liability and pay zero taxes. thanks to this. So if you want to take advantage of that type of strategy, you're going to have to just put in the work and do the compliance end of it, which is tracking your time.
Excuse me. What about the qualifying like type activities? Because I'm sure there's got to be certain parameters. Like, maybe like attending a seminar, would that account? Education at all, or does it have to be like active management of a property? Or
Yeah, great question. So I'm going to kind of backtrack a little bit and give the overview. So in order to qualify as a real estate professional, you have to meet that 750-hour requirement. That comes from a real property trader business, which is typically construction, development, like fix and flipping, stuff like brokerage. So you could be a real estate agent or a broker. You could be a property manager. You could be a buy and hold investor. All of these things will get you to the 750 hours. But to actually deduct the losses from your rental real estate against your ordinary income, you also have to prove that you materially participated in your rental properties. And this is typically done by spending 500 hours of rental activities across all of your rental properties. So to answer your question about travel is a little bit of not travel, excuse me. Seminars and educations. Yeah. It's definitely a little bit of a gray area. You want to be spending most of your time on like true management activities. And what I mean by that is showing tenants the units, coordinating repairs and maintenance, renovation expenses, screening tenants, things that are actually going into the management of the properties that you own. Now, we always say that you should document your training hours, and it could help. But if you don't want to have 50% of your time coming from training, if you want to have it, most of it coming from bona fide, rental activities.
And there was another thing I remember hearing. This was quite some time back, where I guess one of the workarounds, especially if, like, let's say if you're a physician, right? I mean, a doctor's got to have a pretty busy schedule, working a lot. But your spouse could qualify for real estate professional status. Is that correct? And then how would that work? Okay.
Yeah. So the way it would work is that, excuse me. Let's just say that you're a physician. You work 3,000 hours a year. You're not qualifying. So your spouse can. Let's say your spouse works a part-time job or doesn't work at all. They have to meet the 750-hour test. If they meet the 750-hour test and more than half of their total working time, they're going to qualify as a real estate professional. And when they qualify as a real estate professional, you both are now considered a real estate professional if you file jointly. And then that means that your spouse can go and run your real estate operations. You can go do cost segregation studies on your properties, and you can use those losses now against your active income, your W-2 income, or your business income from being a doctor. So yes, that's how it works. Your spouse qualifies, they run the real estate operations, and then you're able to use those losses against your income too.
Would it matter, let's say that, because if you're buying, like, the management entity, right? And if your name personally, let's say like Thomas, your name is on that management entity, that LLC, but your spouse's name is not on that, does that even matter?
Yeah, so that's a great question. For the most part, no. And the reason for that is because it's like this related party rules, not to get too technical, but because you're married, it's generally going to be considered to be the same. Now, those rules may vary state to state, so it's important that you talk to your tax advisors and legal counsel on how that works. But generally speaking, you don't have to be on the same title, although we typically recommend that you do, just to avoid any potential arguments that tax authorities could make.
What do you see some, I guess, areas or mistakes that investors are making, or missed opportunities when it comes to the tax code in getting maximum benefit for deductions?
Yeah, I mean, I think a lot of people make the mistake of just not getting any advice. They go and they just go into it blind and just kind of wing it. And if you get the proper advice, I've seen people who are real estate professionals, right? Who are clearly real estate professionals, not elect the status. So that's one. If you are a real estate professional, make sure that you're electing that status. I've seen people who purchase properties who are real estate professionals and not do cost segregation studies. So it's important that you maximize those losses. One of the biggest things I see people do is putting rental properties in an S corporation. S corporation, there's nothing particularly wrong with doing that. But when it comes to getting properties out of an S corporation, anytime you want to pull a property out, it's considered a sale. So if you own an S corporation and you want to move a property from your S corporation to your LLC that you have to sell it, and you're going to have a taxable event. So generally speaking, investors should avoid having properties in S corps, rental properties specifically in S corporations, and that's probably the biggest mistake I see. Other times it's just not taking depreciation on your tax returns. Another big one. Like, we'll review a lot of tax returns from other CPA firms that come across our door, or self-prepared returns, and they don't take depreciation. And the IRS, whenever you sell a property, the IRS assumes you did take the depreciation, is going to charge you the tax on the amount that you should have taken. Those are a handful of mistakes I always see.
Are there any special tax implications when it comes to purchasing a property or placing a property that you have in the name of a trust?
Yes, that's a great question. It depends. It depends on the type of trust. Most people are placing their properties in a revocable living trust. A revocable living trust allows you to basically put your assets, not only your real estate, in there, and when you pass away, it'll go to whoever the beneficiaries are, like your children, for example, without going through the probate process. The probate process costs money, so there's usually not too many issues when you're doing that. Specifically, when it comes to irrevocable trusts, it gets a little bit more complicated, and I'm honestly not too familiar with those at the moment. But revocable living trust usually is not too many issues doing that.
What about the land trust?
Oh, the land trust. The land trust, yeah. So land trusts are basically used to basically a legal tool to help you transfer properties within in and out of LLCs, and also maintain anonymity. And I can't basically anonymously. Yeah, exactly that word. And that's usually more on the lawyer side of things. Lawyers typically handle that. So I'm not too familiar with the exact mechanics. We always have attorneys handle that aspect of it.
Yeah, but there are no, I guess, differences as far as like tax implications of that you know of, or.
Oh yeah, no. Usually the land trusts help avoid the transfer tax. Transferring a property from your name into your LLC's name will generally can cause a taxable event in some instances in some states. So land trust helps bypass that. But in terms of like having your property in the land trust itself doesn't cause any tax implications.
What kind of a savings would you, it's just basically be a regular transfer tax, as though you're just transferring it anyways, even though you're technically not transferring it, right?
Yeah, so it all depends on the state. All states and some localities, some counties have different tax transfer laws. And sometimes it's 1% of the purchase price. Sometimes it's like $500 for every $1,000. Like $500 for every $100,000 or something like that. It really depends state to state, but in some states it can get quite expensive. Like if it's a state that's like, I think Florida, for example. Don't hold me to this, but I think Florida's like a 1% transfer tax. So you transfer if you sell $1 million property with a 1% transfer tax, that's I think comes out to be like $10,000. So it can be significant if not done right. So that's why land trusts are typically used.
Mm-hmm. What advice would you have for new people getting started with real estate?
New people, the biggest advice I can give someone is reading is great. Reading and educating yourself, like on podcasts, like by listening to podcasts like this, is the first step. But you have to get around people, get around communities of people who are doing the actual investing, and build relationships with those people and get in the game. That's how you're going to get into the game. You're going to see these people doing these transactions, and they're going to rub off on you in a positive way. So that's my biggest my biggest advice would be to get around people who are doing it as soon as possible and learn from them, try to get involved with them. They're going to motivate you to actually get the job done, because at the end of the day, education's great, but without action, you don't have anything. And the best way to take action is to get around people who are already doing it, and then they'll kind of like elevate you to the level you need to be to start taking action.
Yeah. And do you have a good book recommendation?
A good book recommendation. Yeah, there's so many good books out there. It's tough. It's tough. I would say that from a real estate perspective, I mean, I would say the book by Joe Fairless, the syndication book he put out, is pretty good. But if I'm going to pick a general book on business, it's going to have to be Never Split the Difference by Chris Voss. Excellent book on communication and negotiation, and so many great principles out there that are going to help you in the real estate business as well, probably in just your day-to-day life.
So, one thing I wanted to point out, and just as a reminder to our listeners, that Thomas, you are more than just a CPA; you're an active syndicator as well. So, I just wanted to be very clear, to everyone about that. So, if anybody wanted to reach out to you, and maybe discuss like some deals or things that they're working on, or perhaps they can raise capital, how could they get in touch with you?
Yeah, so the best way to get in touch with me is probably on LinkedIn or Facebook. You could find me on LinkedIn, Thomas Castelli, CPA. I'll be like one of the first people that pops up. Same thing on Facebook. You can also email me. My email is hello@thomascastelli.com, just typically where I receive emails. And that's the best way to get in contact with me.
And also, one last thing too, you have a podcast, right?
Yeah, so I'm co-host of the Real Estate CPA podcast. We put out an episode every week. We bring on guests that speak about their journey in real estate, what strategies they use to build their business. We have guests who specialize in certain tax strategies that can help you basically minimize your taxes on the sale of your business, or help you understand cost segregation studies better. So all of that can be found at the Real Estate CPA podcast on all pretty much major podcast platforms.
All right, Thomas. Well, thank you so much for joining us today. I really appreciate your time.
Oh, thank you for having me on, Dion. It was an honor.